We know the Delta variant's top of mind with the consumer, and it's certainly something we're watching closely.
COVID is a real disease that gets people really sick, and vaccines protect against those real diseases that get you really sick. So the silver lining is we're now taking COVID seriously, which means people are getting vaccinated.
Vaccines are the best defense, but masks are extremely helpful as well.
To end this pandemic, we have to protect the American people, and we have to continue to do more and more to vaccinate the world.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Tilting towards tapering, the Fed is moving towards cutting asset purchases by the end of the year, but it hasn't decided how fast to go. Alibaba falls to a record low in Hong Kong after Tencent warns of further regulatory curbs. Beijing also pushes to cut steel output and rein in house prices. Iron ore leads metals lower. And the IMF cuts off the Taliban. It blocks Afghanistan from funding just days before Kabul was set to get almost $500 million. Exiled Afghan President Ashraf Ghani reappears in the UAE, saying he hopes to one day return home. So let's get straight to our top story, and the Federal Reserve is in alignment on when it will wind down its asset purchases. Minutes from last month's meeting show that the FOMC largely agreed that tapering should begin this year. Now, oil also sank to its lowest since May, and the dollar gained. Even as surging inflation grabbed policymakers' attention, several meeting participants are still concerned that price increases could actually slump back to 2%, or below 2%. Meanwhile, some investors are concerned that any large and sustained move of inflation in either direction could also hurt portfolios. Well, yesterday we spoke with Nikolai Tangen. He is the chief executive of Norges Bank Investment Management about the potential for a double shock.
We are at a situation now where the bond yields are extremely low and the stock market is extremely high. And so therefore, any main change in inflation will hit both part of the portfolio, you know. And in the past, it hits one of them and not the other. But this time it can move in, both can move in the same direction.
Well, that was the boss of the biggest sovereign wealth fund in the world, speaking to our Jonathan Farrow. Now we're joined by Kokou Agbo-Blugwa, Global Head of Economics, Cross-Asset and Quants Research at Societe Generale. Kokou, thank you so much for joining us. When you look at the markets and actually try and figure out, what's going on, stocks are down. I don't know whether it's August, and so we're going to see some quirky moves as we do in the summer months, or whether there's a real underlying concern about growth because of the Delta variant and that the Fed could act too soon.
Well, I think if you take a step back, the markets have had a tremendous year. I mean, the European markets are up between 20 to 23%. The US market is up between 15 and 20%. It's only Asia and China in particular that's struggling with the regulatory tightening. So it's normal to see a bit of a pullback in a context where you see negative real bond yield, because level of bond yield are pretty low, and inflation expectations have been pretty stable. So this is an environment that's very bullish for risk assets. And the backdrop of earnings have also been pretty strong, even though you saw a few profit warning here and there. But the aggregate earnings momentum is still very conducive to a bullish context for risk assets.
I mean, I know you see, for example, the 10-year Treasury yield at 2% by the fourth quarter of this year. Kokou, it seems that, everyone's looking at the same data points, but actually the interpretation of where Treasury yields could go is between 1% and 2%. Why this huge divergence?
Well, this is a very good point, and this is why we put in our risk outlook, or market risk outlook, which is a publication that looks at different distribution of outcomes, and we called it Delta Hedging, which is a pun with around the Delta variant and the risk that investors are facing. So there's essentially three outcomes. So a base case scenario, which we have roughly at 60% probability, whereby we have a orderly tapering and exit of that liquidity. And then the tail risk is more on the downside, 16% probability, is where the Delta variant gets worse and the data sort of gets worse towards the end of the year. And then the upside case would be a much faster growth and revenge spending with all that excess saving that get deployed into the economy. So the distribution and range is being so high is because of these uncertainty around inflation, unemployment, and the Delta variant. Our view is that the tapering will start towards the end of the year, and the Fed currently buying $120 billion of bonds every month is one of the driver of low bond yield. And over time, the balance of forces should push toward higher nominal bond yield.
But when do we find out? I mean, if the market, let's say, it's a bit of a jargon, but it's bifurcating, meaning that you interpret the same data, but actually could go either direction. When do you think we'll be settled on actually what the right call is?
I think towards the end of the year. I think the next employment data is on September the 2nd, and then the next FOMC meeting is on September the 22nd. So I think this is where we'll see a bit more evidence on whether the recovery and growth is sustainable and strong enough for the Fed to start tapering. And I think it's really important for people to realize that this is a sort of a decision tree, almost playing a chess game between the Fed, central banks, and market participants, and a bit of a schizophrenic mindset between whether we're going into double tapering of fiscal and monetary at the same time, which would slow down growth. And then you have to realize China as well is slowing down pretty fast as well. So that is effectively data dependent, and that's why we could see more rate volatility going forward.
Coco, when you look at some of the things out there that actually the market is looking at, are we putting too much emphasis on the minutes from yesterday because they're backward looking?
Well, this is a good point. I think the Fed is, and Jay Powell has been pretty explicit in terms of his view on the transitory nature of inflation, and that he doesn't see a sort of sustained level of price increases going forward. And therefore, he was pretty clear on looking at maximizing employment whilst maintaining price stability. So obviously, all data are backward-looking by definition, and markets and central banks have to infer some sort of forward-looking information based on backward-looking data. And that's why it's a tricky equilibrium exercise where you have to find the optimal decision based on backward data. But the model and the framework remains that the massive fiscal stimulus that we saw last year and this year have helped spur a new growth and GDP momentum in the US at least. And this should be sustained at least for 1 or 2 years. But it is also clear that most governments are looking to repair their balance sheet after the massive deficit they've incurred. And therefore, the risk going forward is this double tightening, both monetary and fiscal, which could slow down growth. Yeah. And that's why ultimately it's an exercise of balancing between all the different scenarios.
Coco, thanks so much. Coco Agbablua there from Societe Generale stays with us. Now, coming up, China pledges to curb steel production. Iron ore futures trade at the lowest in 8 months. Oil is also lower. We discuss commodities next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, commodities from oil to iron ore are all tumbling in today's session. A number of factors weighing on the asset class, including China, where regulation and production curbs are pulling commodities lower. So let's get the very latest with our Danny Berger. Danny, good morning. And it's a down day for commodities.
It really is a down day. As you said, there are a lot of factors here, but I need to start with kind of the most obvious one, considering we had those FOMC minutes yesterday. We get this consensus that tapering will happen. When it happens, that's not totally clear. But either way, that means that King Dollar is absolutely in play today. Over the past 4 days, we've seen the dollar rise by 1%. So what happens when you have a stronger dollar? That means that all those dollar-priced commodities are under pressure. So let's switch up the boards. Let me show you what commodities are doing, because it is a really ugly day, as you said, Francine. I mean, look at iron ore, down nearly 11%, taking out its year-to-date lows. You also have things like steel under pressure, copper and oil. So part of this is demand, a stronger dollar, but also China features really heavily in here as well. China is doing more to curb the production of steel. So that's why we see some of the steel under pressure. At the same time, China is seeing their housing growth in terms of housing sales growth be at the slowest pace in 6 months. This has started to reignite fears of a housing bubble. So in terms of where the regulatory picture goes next for China, it's reigniting that idea that it's perhaps the housing market. So all of that, all of the materials that you would use in building houses sinking lower today, Francine.
Danny, thank you so much. Our Danny Berger there with some of the latest commodities being crushed. Now, meanwhile, the sell-off in China's biggest tech names continues. Alibaba fell to a record low Thursday after Beijing hit the industry with a new round of regulation. Rival Tencent also warned investors that further rule changes were coming as the company posted its slowest sales growth in 2 years. Well, Kokou Agbo-Bloua from Société Générale is still with us. Kokou, first of all, what do you do with some of the exposure that certain markets have to China? Is it all bets off now because we don't exactly know how much further regulation there is coming?
Yeah, clearly the uncertainty is pretty high. And I think it's important to realize that China is changing the rules of the games when it comes to what matters to them. So in the Western world, when you look at equities, you typically have this idea or concept that shareholders are sort of at the top of the stakeholder food chain, so to speak. So you maximize return, which is your fiduciary duty. And China is effectively saying, well, in fact, shareholders are not the core of our focus. It's really society and what they conceive or perceive as fairness based on their principles. So if you look at the private education sector, it's not just about sort of making money and maximizing return. It's really about avoiding rising inequality in terms of access to education, etc. So I think there will be a level of adjustment in terms of fair value for these assets. But at this stage, the volatility is just too high. We need to see where the rules of the games set before market sets new fair values for these equities.
So, Kokou, we talked a little bit about rates. Where are you on credit? If you look at some of the asset classes, credit, FX, where are you going to see the most volatility?
I think credit, we are pretty comfortable. We think credit is going to tighten further in terms of spreads, simply because companies have managed to repair their balance sheet at an incredible speed. And we've called it the vaccination of zombies, because before the crisis, we had a bad balance sheet problem where you had a lot of these zombies, which are companies that are not profitable, but are effectively kept alive by cheap liquidity of central banks and governments. And we were expecting a massive round of default, and this did not occur simply because government injected so much liquidity into the corporate sectors and paid wages for a vast part of the economy, and this allowed companies to repair their balance sheet, cut costs, deal with their working capital, etc. When it comes to FX, we think volatility in FX is likely to rise going forward, and when it comes to equity, we're still pretty bullish in terms of the sort of cyclical sectors, given all the green infrastructure, climate change transition, etc. That's happening.
So, Kokou, if you look at, for example, some of the FX moves, and dollar really caught our attention over the last 2 weeks, where does dollar actually go next?
I think the dollar, there's a concept of the dollar smile. So when you have a massive, a tightening cycle, the dollar typically strengthens, coupled with growth. And then when you have a massive risk off, the dollar also strengthens. There's a sort of a level where the dollar underperforms is where emerging market and the rest of the world does better. So I think the momentum here is for further dollar strength, given how decent the data is in terms of employment, etc. So I think we have further strength in the dollar of around 5-6% versus the euro at this stage.
And on emerging markets, are there specific emerging markets actually where we could see value?
I think when it comes to emerging markets, it really is dependent on the Delta variant and the supply chain bottlenecks, etc. So we are still pretty bullish, generally speaking, in terms of emerging market as a whole, taking advantage of that diversification from LATAM, etc. But we do have a preference for Eastern Europe.
I know yesterday there was a bit of movement on VIX. Again, it comes from a very low base, so I don't know whether you're more interested in looking at VIX or actually whether liquidity is something that we should pay a bit more attention to.
I think the VIX is going to have spikes, so overall volatility is likely to drop going forward on the equity market because of this massive sector rotation that's going on and the decent earnings momentum and credit spreads not being an issue, at least in the short term. So therefore, we'll see more volatility, but the overall level of vol is likely to remain low for the equity markets. And liquidity is a very good point, because low liquidity does create a negative feedback loop when it comes to volatility in terms of creating bigger dislocation. So the summer period is usually an environment where liquidity is low, but as we move towards September and people come back to work, so to speak, I think liquidity should be something that's more manageable. But that being said, systematic strategies and algorithm trading have also been one key factor to monitor in explaining asset prices and the dislocation versus fundamentals. We talked about it, US 10-year bond yields not being too low versus where inflation is, for example. So I think this is another aspect to watch out for.
Coco, thank you so much for all of the insight. Coco Agbo-Blua, their global head of economics, cross-asset and quant research at Societe Generale, joining us this morning. Now, exiled Afghan President Ashraf Ghani resurfaces in the UAE. The IMF cuts off the Taliban. We discuss the latest on Afghanistan next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. A large UK study has found vaccines are less effective against the Delta variant of COVID-19. The Pfizer-BioNTech shot was 93% effective against symptomatic infection shortly after a second dose, compared with 71% for the Oxford AstraZeneca jab. However, Pfizer's efficacy ebbed over time to reach a similar level. The study also found vaccination doesn't diminish the viral load carried by those with the Delta variant. The U.S. is to start offering booster shots to all vaccinated adults from September 20th. The move is a massive expansion of a program previously limited to those with weakened immune systems as infections from the coronavirus Delta variant surge. The U.S. is facing a new wave of COVID infections, primarily among the unvaccinated. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Angel, thank you so much. Now, President Biden says U.S. troops will remain in Afghanistan until all Americans are able to leave the country, even if it takes longer than his August 31st deadline to withdraw. While speaking to ABC News, he also said pulling out of the country was never going to be easy.
The idea that somehow there's a way to have gotten out without chaos ensuing, I don't know how that happens.
Meanwhile, exiled Afghanistan President Ashraf Ghani defended his decision to leave Kabul as the Taliban advanced and toppled his government. Well, he spoke from the UAE.
That was the failure of the government leadership and also the political failure of the international allies. This is the failure of the peace process that changed to a war process.
Well, joining us now is Bloomberg Opinions' Bobby Ghosh. He has a column out this morning entitled Taliban 2.0 versus Afghanistan 2.0. If you want to read it, info, just go to OPIN, go on the terminal or on Bloomberg.com. And Bobby joins me here in the studio. Bobby, thank you, and thank you for all of your columns and your wisdom. First of all, when you look at, so what we're trying to figure out is actually if the Taliban have changed. So if this is going to be a more moderate Taliban, as they have said, or whether this is just smoke and mirrors.
Well, we should be very careful. They're saying all the right things. There was that press conference a couple of days ago, and the Taliban spokesman says we want women to be able to participate in the economy, participate in society. We will give amnesty to everyone who has worked with the previous government, and all things of that nature, that they will not harbor terrorist groups and extremist groups and make sure that Afghanistan is not used as a base to attack other countries. But they've said things like this before. They said, pretty much similar things when they first came to power in 1996. So, and their track record in parts of the country where they have been controlling for many months now and years now does not inspire optimism. In those parts of the country, women, once the Taliban took over, women were no longer allowed essentially to leave the home. Burqas were made compulsory. They were not allowed to work. Schools were closed down. So we should be very cautious. The one thing we know for absolute certain is Afghanistan is not the country that it used to be. It's not the country that the Taliban were driven out from power 20 years ago. It's a much larger country. Population is more than doubled. It's a much more urban country than it used to be, although it is still very poor. very, very large proportions of the population now have access to technology, they have access to cell phones, and are much more connected to the rest of the world. So the old Taliban, if the Taliban hasn't changed, it may be forced to change because the country around them has done so.
Bobby, quickly, how effective can the IMF actually be in cutting off the Taliban with that? You know, it was a lifeline, actually, that they were meant to give to Afghanistan.
Well, the IMF has said that until the international community recognizes this government, they cannot have access to the $500 million. What we don't know is whether the Taliban cares about this sort of thing, whether they really genuinely care about being part of an international economy, part of an international community. That's to be seen.
Bobby, thank you so much. Bobby Gosh there from Bloomberg Opinion. Now, coming up, digital innovation continues to make markets more accessible. We'll be joined by Fidelity International's Ann Richards to discuss how those innovations are reshaping the financial world. This is Bloomberg. Tilting towards tapering, the Fed is moving towards cutting asset purchases by the end of the year, but it hasn't decided how fast to go. Alibaba falls to a record low in Hong Kong after Tencent warns of further regulatory curbs. Beijing also pushes to cut steel output and rein in house prices. Iron ore leads metal lower. And the IMF cuts off the Taliban. It blocks Afghanistan from funding just days before Kabul was set to get almost $500 million. The exiled Afghan president, Ashraf Ghani, reappears in the UAE, saying he hopes to one day return home. Well, good morning, everyone. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 19th of August. Now let's get straight to our Danny Berger for some of the U.S. pre-market movers. Good morning, Danny. What do you have?
Good morning, Francine. Well, starting off with a little bit of earnings, Robinhood diving almost 12% after falling post-market after their earnings. The issue here is that all comes down to cryptocurrency. Cryptocurrency was more than half of their revenue in the second quarter. It was more than stocks and options trading combined, and that might sound good, but the issue here is that Robinhood is warning this boom in cryptocurrencies may not last. And not just that, but within cryptocurrencies, 62% of the revenue was from Dogecoin. So you might be getting a sense that betting on Robinhood is in a way betting on Dogecoin, which is, of course, highly speculative. We also have Alibaba. Francine, you mentioned this, dropping more than 4%, trading at its lowest price in Hong Kong trading. This is, of course, the US ADR. We had concerns emanating from more regulation. China saying that it may continue to crack down on things like online streaming, driving apps, those sorts of things, and Tencent in their earnings yesterday. Also saying that governments can control how those types of companies use their data in advertisements. The final one I have for you, Francine, Toyota dropping 3%, also falling during the Japanese session as well. The Nikkei reporting that they're going to cut their production 40% for September. It all has to do with the chip shortage. It's continued and getting even worse considering the Delta variant outbreak in Southeast Asia means that a lot of those supply chains are yet again under pressure, Francine.
Danny, thanks so much. Our Danny Berger there with some of the U.S. pre-market movers. Now, also, don't miss our interview later this morning with Bob Carter. He's Executive Vice President for Sales for Toyota Motor North America. That's at 10:30 a.m. UK time. Now, over the past year, we've seen significant change in the financial world, an explosion in retail trading, the SPAC boom, and the rise of NFTs. Ann Richards, Chief Executive of Fidelity International, sees these changes reshaping the transmission mechanism between markets and the real economy. Now, she says that innovation will continue to bring digital services to the forefront of the financial system and decrease frictions with help market trends move faster. Well, Dame Ann Richards joins us now. Thank you so much for being with us today, especially on a pretty big news day where the market is trying to find a direction, looking at the minutes, looking at some of these huge shifts, which is sending commodities lower. And what's the biggest risk to the financial markets right now?
We're in uncharted territory in general. We've got the biggest fiscal taps opening that we've had in decades, at the same time as we're in still completely new territory with monetary policy, because we've had QE at such scale and for so long now. So that I think the biggest risk for markets is simply we're learning as we go in terms of what the policy responses are going to affect and actually create in markets. And this economic cycle has been almost like an economic cycle on speed. We had that dramatic plunge in activity last year. We've seen the most dramatic acceleration of growth after that. We've seen inflation accelerate in a way that we've not seen again for many, many years. And now we're possibly starting to see a slowdown in that acceleration. So it feels like everything has been happening at lightning speed. We've gone through an entire economic cycle, it feels like, in the space of a few months. So I think the risk for markets is really that we are playing in a space that is very different to anything we've played in for many, many years, if at all.
Which means, and that actually we could see huge mistakes. Are we underestimating liquidity? Is there something out there that actually makes you worry about the functioning of the markets?
No, I think if you think back to sort of 15, 16 months ago, that liquidity was a real concern, and the actions of the central banks globally, I mean, very much led by the US and Europe, but to ensure that the liquidity in the system was there, I think have taken away the liquidity fear as the primary fear that markets have in that sense. I think the issue today is whether the policy responses that policymakers are going to have to make, and it's a very difficult and fine balancing act, that they make a misstep on that. But if they make a misstep, I think they are likely to tighten too late rather than too early, just because we're still in an unknown territory with the pandemic, with what happened. We've got Delta accelerating, obviously, but what else happens? Could they see it be another mutation? So I think if there's a risk of a policy mistake, it's probably that they leave it too long to tighten rather than that they tighten too soon. But as I say, I think it's just the pace and the speed with which things have been developing that just make it a challenge for people to make some very tough decisions, if you're sitting in that policy seat.
But is that also the pace of technology? I mean, if you look at the pace of change, you're right that it's incredible actually what we've lived through in the last 18 months. What will be actually the legacy of this pandemic?
It's the acceleration of technological change. I think that's totally right. I mean, you were mentioning a moment ago about Robinhood and crypto trading. I mean, the crypto assets have accelerated not as a consequence of the pandemic, but nonetheless have been facilitated by the move to the virtual world that everybody has participated in, or at least many, many people have participated in as a consequence of the pandemic. And crypto assets in aggregate are something like $2 trillion now. I mean, it's a massive, massive sum of money there. But on top of that, as a consequence of that move to the virtual world, when we talk about the transmission mechanisms that underpin the financial system, if you think in terms of wavelength, if you think in terms of frequency, you can see that, again, that acceleration has come through, so that the way that central banks are thinking about digital currencies, they don't have time to design the perfect digital central bank currency because of the pace at which technological change has meant that the world outside the central bank world has just moved so very rapidly. And that has consequences because of how banks have been set up. And so the choices that central banks are going to have to make about taking digital transactions and actually thinking about what that means for a digital currency, if there should be a central bank controlled digital currency at all, they're big, hefty decisions that will have very direct consequences on the shape of the banking system, and in fact the shape of the way that you and I interact with the financial system over the years ahead. And this acceleration, this pace, has been something that is again, we're in uncharted territory.
So, and what does it mean for Fidelity International in terms of how you look at crypto and how you want to get involved in that space?
So we run with various different pilot projects at any moment in time on any kind of new technology that is evolving, and different parts of the Fidelity world are involved in different ways. We have a business in the US which looks at crypto custody, for example, because crypto asset custody, how do you keep that safe? That's been a very important part of actually how what was a sideline becomes more mainstream. It's the key part of making that safe. For us, when we think about portfolios and we think about asset allocation, I think in general our clients are looking at crypto and looking at it cautiously rather than rushing headlong into saying we want to do X, Y, or Z. But we are starting to do modeling and looking at the impact on in portfolios if you have crypto asset. What are the implications of that? How does a crypto asset, for example, how does that behave versus gold in a portfolio? So I think we're still at the early days for kind of mainstream investors thinking about how to pull these things together. But those are the sort of things that we talk about internally.
And how much did Fidelity actually change their stance on China because of the regulatory crackdown we saw over the last couple of weeks?
Well, obviously, it's been ongoing for more than the last couple of weeks. It's become, particularly in the education sector more recently, that's been a thing. But obviously, in the technology sector, it started earlier. And I think this is partly an example of where, if you stand back and look at the shape of what's going on in China in general, it believes that there are certain very important parts of the economy, in education, in health, there would be classic examples, where it has realized there needs to be more robust, more comprehensive regulation. And that is something that actually every developed market comes to. And I think China is going through that. Now, sometimes the implementation of that is a bit clunky. It's not necessarily as well managed as it might be in certain places. But the big trend is an improving regulatory environment, which actually ultimately will be better for business.
I think this month, actually, China allowed Fidelity International to launch a fund management business there. I mean, are you comfortable, about the risks surrounding some of the regulatory things that we were just talking about?
Well, look, I think, in every country that we are in, there are different regulatory pressures, and you see them in China, but you see them in every other country that we operate in, and we just we accept and we adapt to whatever the regulatory environment brings to us. But we've been in China for many years. This isn't new. The thing that is, in fact, I think we were the first wholly foreign-owned company to be given a private mutual fund license. So this builds on the presence that we already have there. And we've found that as long as you are transparent with the regulators and you work with the regulators to understand their concerns, we've found that has been a productive relationship and a constructive relationship, and we anticipate that will continue.
All right, Dame Ann Richards, thank you so much. Chief Executive there of Fidelity International stays with us, and we'll talk a lot more about the world of finance changing from bigger payouts to junior staff, of course, flexible working to an increased focus on diversity and sustainability. We'll discuss all the trends and all of the outcomes with Ann Richards next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So let's get straight to your Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Thanks, Francine. Shares in Toyota have slumped as much as 4.7% after a report the global chip shortage will force it cut production for September by 40% from its initial plans. The world's largest automaker had intended to build about 900,000 cars next month, but according to Nikkei, that number has been reduced to about 500,000. Adyen has reported first-half net revenue growth ahead of analyst estimates. That's after the payment processor said customers' lockdown preferences for online shopping and using cash alternatives have become ingrained. The Dutch company handles transactions for companies including Uber and McDonald's. And that's your Bloomberg Business Flash. Francine?
Thank you so much, Angel. Now, the world of finance is undergoing big changes in the wake of the COVID-19 pandemic. Just this week, Goldman Sachs became the latest Wall Street bank to boost pay for junior bankers to over $100,000. At the same time, debate rages over the viability of flexible working in the investment industry, with U.S. and European banks split down the middle when it comes to requiring face-to-face time in the office. And to that, the growth of sustainable finance and even linking payouts to ESG criteria. And it seems like and all changing for the industry. Well, let's get back with Dame Ann Richards, Chief Executive Officer of Fidelity International. And thank you so much for staying with us. When you look at how the financial industry in general is changing, what are you working on to adapt to some of your other competitors? Is it junior pay? Is it working from home? Like, what do employees want now?
Well, I've never met an employee who didn't want more pay at any moment in time, and I probably put myself in that. So I think, I think that that's a fair and that's a given. And there is some pressure out there. But the thing that is has been really clear, and it's been so interesting watching how other companies have approached this, is when we ask our staff, we've been doing pulse surveys all the way through the pandemic, just to sort of take the temperature of how people are feeling and what it is that they want. It's fair to say that people don't necessarily want the same thing at every moment, in the summer versus the winter, when the kids are at home versus when they're at school. And so we've seen that drive, that desire for a bit more agency and a bit more dynamism in how people interact with the office as being, that is something which I think we can adapt to with much more flexibility than some other companies seem to feel that they can. And what I mean by that is I think it's been pretty clear for us, there are some things that we do want to bring people together in the office for, that we think are really invaluable in the office space: creativity, serendipitous idea generation, just learning from sitting next to somebody who's absolutely brilliant at what they do. All of those things are quite difficult to recreate in an entirely virtual world. So there are some things where you can see there's real huge compelling reasons to bring people together. But I don't believe you need to have people in the office 8-10 hours a day, 5 days a week in order to do that. So I think for us, we've said to each individual area, go away. We've given people some starting templates, 5 or 6 different working patterns, if you like. Go away, pick one, might be a certain number of days a week or a certain number of weeks a month. Pick one, see if it works for your team, trial it for a couple of months, come back and tell us what it's like, what worked, what didn't like, and adapt in that way. So, we're just going to have to keep nimble on this, I think. I don't think anyone has the perfect answer, but I think we can be quite adaptable.
Do you feel like you need to increase actually the pay of junior staff?
So I think we're definitely seeing, you can see in the inflation numbers you've been talking about on the show and elsewhere, inflation is definitely a thing, and we will be responding to that. But as part of our normal annual compensation round, which we go into towards the end of the year. And I think, we'll be, as we always do, I mean, there's no difference this year. We'll be looking at what is going on in each individual country and at what is going on in each individual area within the business, and making sure that we remain competitive within that. We're not taking the approach that, you've seen with some of the investment banks, for example, who've got deeply unhappy staff in certain areas and are potentially taking some particular actions to address that. We don't feel we have that same pressure, but we'll obviously be looking at wages, as you would expect, in our normal compensation round, which we're just about to embark on, given that we're very nearly into September.
And Fidelity International also last month warned that you would basically take action, or you would punish portfolio companies that don't do enough on diversity in the boardroom and that don't do enough on sustainability and climate change. How do you measure that?
Look, in terms of getting the first step is encouraging companies to disclose. And disclosure is definitely dramatically better than it was, but we want people to disclose not just what's happening in the boardroom, but what's happening within the executive function, what's happening within their workplace, the environment, their workforce at large. So disclosure is an important first step. And once you've got that disclosure, then you can start to look at what is the path to progress for each individual company. And we're not asking companies to go on a journey that we ourselves are not already on. So we know that there are some challenges around about that. But the first thing is to encourage companies to look at their own workforces, figure out what their baseline is, and then build that plan for progression around about that. And so really what we're trying to get at, what we're trying to measure, is from wherever you're starting, what is the progress that you are making, across a range of different measures, and diversity will be one of them.
I mean, should bankers' pay actually be linked to some kind of ESG efforts?
So that's a really interesting one. I mean, the more granular you make pay linked to specific measures, the more you risk unintended consequences and outcomes. So I definitely think there is merit in making it clear that this is a strategic priority and should be treated and rewarded as a strategic priority from progress. But I think you have to be, when you get down to individual levels and individual metrics, you need to be absolutely sure that you're not building in unintended consequences. So I would start with it being a strategic objective for the business as a whole and letting reward and compensation flow through from that rather than starting saying you need to do X, Y, Z in this particular team today. And I think building systemic change by looking at things like, how do you do recruitment? How do you ensure you don't have unintended bias in your recruitment process? How do you do your performance evaluation? How do you make sure no unintended bias in performance evaluation? These are the really meaningful systematic things that you can put in to affect change. And then once you have those broader strategic things in place, it's then easier to look at individuals and say, what's the progress that they need to be responsible for within all of that? But you have to make sure you get the big picture right as well as the individual level stuff.
And I also want to ask you about how you see London, being reshaped post-Brexit. So is there any regulation that you think is needed right now, or actually that, the UK should be getting rid of right now?
Really interesting one, actually. I mean, there's been such a lot of discussion around, a range of different things. But actually, when you talk to many people in the industry, with the exception of one or two things like unintended consequences of Solvency II, for example, which is potentially limiting the ability of insurance company balance sheets to invest in some of the, the green infrastructure that they might want to, just because of the way the capital loading works within Solvency II. So I think there are one or two specific things like that you could definitely see changes happening, which I think would be encouraging to do that. In general, the regulatory environment works pretty well in London for the city. I think the ESG agenda and perhaps freeing up regulation outside of Solvency II, looking at fund structures that allow investment in long-term assets, those are quite exciting developments, but they're not so much about deregulation. They're about thinking how we evolve the regulatory structure to allow us to do new and interesting and exciting things. And so I think that's where the opportunity sits. I don't think there needs to be a wholesale deregulation, but definitely some modification in some places like Solvency II might be a useful thing to do.
And Richard, thank you so much, as always, for your time, the Chief Executive there of Fidelity International. Now, coming up, as European stocks slump in the first 2 hours of trading, we'll have a final check on the markets. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, markets definitely diving. If you look at the equity markets here in Europe, you can see the stocks down by 2.1% overall for the Europe 600 rather. The focus is definitely on commodities. Commodities down. There's worries about the Delta variant and that the Fed could actually taper too soon as Delta variant increases. This is Bloomberg.
It's absolutely clear that we have to acknowledge that the United States will no longer be the policeman of the world.
I think we're going through an incredibly tragic time right now with the fall of Afghanistan, and I think the moment calls for looking forward, not back.
We remain laser focused right now on Hamid Karzai International Airport in Kabul, and on doing everything that we can to continue evacuating Americans, allies, Afghans.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, August 19th. Our top stories today. U.S. troops will stay on the job in Afghanistan. President Biden says they won't come home until all Americans have been evacuated. Time to taper. Most Federal Reserve policymakers agree they can start slowing the pace of bond purchases this year. And Goldman Sachs expands its presence in Europe. The Wall Street firm is buying a Dutch asset manager for $2 billion. Onto the markets, Kailey, and we're seeing a down day, definitely a risk-off mood. The picture, I think, is probably traders being worried that the Fed will act too soon with the Delta variant taking hold.
Yeah, you have some growth concerns in there as well, Francine, and that was definitely evident in the Asian session. Broadly lower, pretty much every benchmark you can think of was in the red. We were down about 0.7% in China, 1% in Japan, and then in South Korea, Taiwan, and Hong Kong, equities fell 2% or more. And really in the Hang Seng, it was tech stocks that were under pressure. That index falling about 3% after a fresh round of regulatory proposals from Beijing. The biggest underperformer within that was actually Alibaba. The shares plunged more than 5% to a record low in Hong Kong. That is one stock to watch. Another individual stock story to watch is Toyota after reports that it's going to have to cut its September production by 40% due to the chip shortage. That stock fell about 4.4% in the Japanese session. In other asset classes, I would point to the Chinese yuan. Yes, it is weaker against the dollar, but against a basket of 24 peers tracked by Bloomberg, it actually is at its strongest level going all the way back to 2016, right around that 99 level. And then I also had to point out iron ore futures in Singapore plunging 12% on the session. Of course, there are concerns that China is going to pull back on steel, and broadly demand picture is looking a little bit softer in the Asian region. As for the picture here in the U.S., it is also definitely a risk-off tone. Futures actually right around session lows. We're down nearly a full percentage point on S&P E-minis. A lot of concern about those Fed minutes yesterday and the idea that tapering will maybe indeed come this year. You are seeing a bit into safety in the bond market. We're down about 3 or 4 basis points on the U.S. 10-year yield. It sits at 1.22%. Broadly a stronger dollar story today, and that, with that weakening demand outlook, is also weighing on WTI. Futures down for a 6th day in a row. The better part of 4 percentage points today, below $63 a barrel, Matt, which is the lowest since back in May.
You know, the moves I find absolutely fascinating, Kailey. And take a look at this world map. WM Go is the most efficient way to get there on your terminal. We see something that you rarely see, certainly these days, very rare. White arrows in each of those countries denotes a bigger than 2% drop. It's been a long time since we've seen a bigger than 2% drop in equities. And it's been a long time since we've seen a lot of the other moves that you're looking at in markets right now. Take a look at currencies, for example. You see euro with a 116 handle. You see pound with a 136 handle. By the way, it's the dollar that's being seen as a safe haven right now. So investors are flooding into that, but they're also flooding into the yen at an even more accelerated rate, the yen gaining ground against the dollar, one of the only currencies to gain against the greenback. You also see, in terms of oil, I had to do a double take on Brent crude. It's the global benchmark, but I first thought I was looking at the NYMEX contract. Brent crude down to 66.16. We were about to hit 70 yesterday, so a huge turnaround in the commodities market, a big move in FX as well. Really, investors had been hitting those hedges kind of medium hard over the last couple of days amidst the Delta variant concerns. But now that you got the Fed minutes out, they start hitting them really hard, Francine. So we're seeing what looks like a pretty significant turning point in this market.
Yeah, it does seem like a significant turning point. And then iron ore's route also accelerated, Matt, as China's pushing forward to that, continuing to curb some of the steel production.
Yeah, this is something I want to ask Eddie Vanderwald about this, because it was my understanding from Eco 101, which I took about 25 years ago, that when you curb production, the price should increase, right? Our story says iron ore falls 10% as China looks to curb production. Doesn't that reduce supply? I know that Kailey mentioned there's a little bit of weakness on the demand side, but if you curb production, that should pretty much equal things out. We'll talk to Eddie about that in just a moment.
Yeah, we will. I think that just China also means, because they're curbing production, then they'll use of it less overall. Now look at what else is ahead. At 8:30 a.m. New York time, we'll get the latest read on U.S. initial jobless claims. Retailers Macy's and Kohl's will report second quarter earnings before the bell, and then Tesla holds their AI day amid recent scrutiny over the company's autopilot system. Now over to Afghanistan, and President Biden says the chaos in Afghanistan was unavoidable after the U.S. withdrew troops from the country. He spoke in an exclusive interview with the ABC News' George Stephanopoulos yesterday.
The idea that somehow there's a way to have gotten out without chaos ensuing, I don't know how that happens.
Joe Matthew, Bloomberg Washington correspondent, joins us now from our D.C. bureau. Good morning. First of all, when you hear the president say that actually it could have not been done any better, do people in D.C. believe him?
Well, it depends who you ask right now. The fact of the matter is the Pentagon made clear yesterday in its own briefing with the Department of Defense, Chairman of the Joint Chiefs of Staff, the Secretary of Defense, that of all the models they looked at, of all the intelligence they reviewed, none of it showed Kabul falling as quickly as it did or the Taliban rolling through Afghanistan as quickly as it did. They were caught off guard clearly with the speed of this advance. And as we heard from Jake Sullivan, the National Security Director, earlier this week, this is the chaos that follows a transition like this. They're making clear that there was little they could have done to control this. And as you're pointing out, a lot of folks, especially Republicans in Washington, are not buying that.
Well, separately in Washington, Joe, the Biden administration yesterday announced its plan to offer booster shots to all Americans starting next month. Yet the FDA and CDC hasn't signed on to that. So is the Biden administration front-running health and regulatory authorities to distract from the Afghanistan situation?
Well, listen, sometimes you talk about the things you can control, and this is something that Joe Biden has tried to keep his arms around in terms of the fight against COVID. There are a lot of questions about this, though, particularly with people who got the J&J shot. They're not part of this. That's a lot of people, and it's going to take weeks, apparently, before we have enough data to tell when a J&J vaccine recipient should get a booster and what it should be. It may not be the same shot. It may be an mRNA. But this is August. We've got a three-ring circus in Washington. When you have COVID, Afghanistan, and infrastructure, this president is having one heck of a summer.
All right, Joe, thanks very much. Joe Matthew there talking to us about the unraveling of, the disaster situation in Afghanistan and its effect on the administration. You can listen to Joe every weekday on his radio program Sound On. That's at 5 p.m. Eastern time on Bloomberg Radio. Now, global stocks falling with U.S. futures. Unconcerned the Fed may start tapering even as the Delta variant undermines growth. Eddie Vanderwalt, Bloomberg Markets live editor, joins us now. And before we get to the move in stocks, I have to point out that my most ferocious colleague on Bloomberg Surveillance pointed out to me, as did a number of viewers, that they're curbing steel production in China. Iron ore is used in the making of steel, and that's the issue. I was conflating the two, but thank you, John Farrow. So that's why we see this huge drop in iron ore prices.
Yeah, absolutely. Iron ore really under pressure there. And it is, iron ore, steel was never really part of this new commodity super cycle that people were talking about. But I think what we're seeing in markets more broadly today is a flavor of just what the taper tantrum will look like this time around. We're not there yet, right? We're down significantly, but I think we're getting a flavor here. We're getting a flavor that this is going to be more about stocks and it's going to be more about commodities than it is about, than it is going to be about the bond market this time around in, when the Fed finally pulls the trigger on that taper.
Eddie, I guess I'm just wondering why this seems to have taken the market by surprise. Didn't we know a taper was likely coming at the tail end of this year?
Yeah, but the minutes were quite aggressive, weren't they? I mean, we're talking about this year now. We're not talking about some undisclosed time in the future. And that comes even before. I think what matters more is that this comes in the run-up to Jackson Hole. Jackson Hole just a week away. And I think that matters because people are really waiting for Jackson Hole for the Fed and other central banks to sketch out what the picture forward looks like. And all of that we'll see next week. But for the moment, I think, just a little bit of jitter. But for me, the interesting thing today is I get a preview of what it is going to look like when we finally do get that trigger being pulled.
All right, thanks so much, Eddie. Bloomberg MLive's Eddie Vanderwalt. Now, Goldman Sachs is also expanding its presence in Europe. The Wall Street firm just bought the asset management arm of Dutch insurer NN Group. So let's get more on this with our very own Danny Berger. Danny, what does this tell us about the attractiveness of Europe?
Well, it tells us that increasingly more banks, just when they buy Europe, they don't want to be buying in the UK. Look, this is a post-Brexit world, so it makes sense for Goldman Sachs to expand their presence in asset management, that they go to the Netherlands, they go to Amsterdam. But what this also does, Francine, is it really extends their ESG offering. NN Investment Group, that's the name of the investment management arm of the firm. About a third of their assets are ESG. So that's really attractive for Goldman at a time when clients are asking for these types of strategies.
What about asset management M&A more broadly, Danny? It seems to be really hot right now. What's driving it?
Yeah. Yeah, well, look, even Solomon, in talking about this deal, really made no secret that it is all about scale. You have asset managers competing with very low fee passive funds, so you have that margin squeeze on all of these asset managers. So if you want to survive, you have to build up economies of scale. You need all of these assets so you can charge low fees and still bring in some pretty significant revenue. So you have Goldman doing this, you had SocGen selling Lixer to Amundi, and you have Allianz out there saying, hey, we want to be participating in this space and in this consolidation. So this is really just one of many more deals that are likely to come.
All right, Bloomberg's Danny Berger, thank you so much. And I do want to check in now on some stocks trading in pre-market trading moving here in the U.S. And one of the big ones to the downside is Robinhood. It had its first earnings report as a public company after the bell last night. Revenue did surge thanks to crypto. Crypto revenue up 4,560%. But the company said that likely isn't going to last, and that is what is weighing on shares this morning. Not all good in the hood. Robinhood down the better part of 13%. Nvidia, though, also reported after the bell a little bit more of a positive story. Of course, it is the biggest U.S. chip maker. It is benefiting from all of the demand, even if supply is still constrained, and it gave a pretty upbeat forecast. That stock up a little more than 1% before the bell. And then, of course, as we were just talking about, commodities under immense pressure today, and that is translating into equities tied to commodities, one of them being midstream oil and gas company New Fortress Energy. It is actually heading for its 9th down day in a row, Francine. It's down about 9.5% before the bell.
Kailey, coming up, Matt Maley, Miller Tabak, Chief Market Strategist, and a little bit later, Nils Schmid, Foreign Policy Representative for the German Social Democrats. We'll talk markets, and of course, we'll talk Afghanistan. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, we've got a chart here that's going to be pretty familiar to most of you watching us on television. You won't be seeing it, obviously, if you're listening on London DAB digital radio, so I'll walk you through it. We've got Fed futures here, December 21 in white, December 22 in blue, and December 23 in yellow. And you can see that we're now pricing in a hike for 2023, and they're climbing a little bit there for 2022 as well. So it's coming on a little bit stronger. Joining us is Matt Maley, Chief Market Strategist at Miller Tabak, to talk about the market expectations. And Matt, I thought it was interesting going through the Fed minutes yesterday. Various participants thought we could see a reduction in asset purchases in the coming months. Several indicated it was more likely to be appropriate early next year, but most thought this year was the time for it. Is this a little sooner than the market anticipated?
Well, I mean, yes, it is a little bit, because they had been saying for a while that's going to be, they would announce it later in the year and it wouldn't be implemented until early next year. Now it's been backed up a few months. So that, that's a concern. But but for the most part, the people should have seen this coming. But at the same time, we do understand that when the Fed is going to be, less accommodative, there's going to be less stimulus in the system. It's going to be less there to push the market higher, and that has people coming up. So being more cautious. And of course, it's like it is usually, it's a combination of things. People are starting to worry about stagflation, with inflation being a problem. So, how could inflation be a problem if the economy is going to be slower? It's like, that's because the inflation is being driven by demand, right, by supply issues, not demand issues.
Matt, is this the start of a longer correction, or is it also a bit of a funny day just because it's August?
Well, I think it's probably the beginning of something. And again, the corrections are normal. They're healthy. We haven't, as we all know, we haven't had more than a 5% pullback all year this year. That's very odd. Usually that doesn't happen. But the thing for me is that, again, this whole thing with inflation, you're having a situation where people are worried about the economy slowing down, even though it may not be anywhere near what we saw a slowdown last year. But like I said, back in the 1970s, we had stagflation because the inflation issue was not because of demand. It was because the supply, they cut the supply of oil and prices went up. This time around, it's this whole supply chain issue that is causing prices to move up, and that looks like that's going to continue longer than people had thought. So that's right now.
Matt, the moves we're seeing in the market today are accelerating. The Bloomberg Dollar Spot Index now at its highest since November. The CAC 40 over in France extending its losses now to 3%. With all of this going on, where do you hedge?
Well, that's always difficult, because when a market is extended, and I say it's overbought and expensive, that makes it really tough, because we've been hearing all sorts of stuff about people saying the rally of everything, and a lot of people saying would continue to the end of the year. Well, if everything's rallying, what's going to happen when things go down? It's hard to hedge yourself. Number one, I think the biggest thing is just raise a little bit of cash. That doesn't mean going to 50% cash or even 20% cash, but it does allow you to keep your head if the market comes down and be able to buy on weakness and not be selling at the exact wrong time.
I was going to say, why not just buy the dip here? I mean, the CAC 40 falling more than 3% because it's got all of those luxury retailers. If they're taking a big hit today, doesn't recent history tell us they're going to bounce back with strength? Yes, recent history tells us that. But intermediate term history says just the opposite. Again, we haven't had a correction. We haven't had a pullback of more than 5%. You know something? I think 2017 is the only year in the last decade where we haven't had at least a 10% correction. So the odds of us having a correction this year are every year are very, very high. So I think people have gotten lulled into the fact of just thinking, oh, just every little dip I've got to buy. This is really only a small dip right now. And I just think people need to be more careful.
So are you more excited about volatility right now? I know the VIX from a low base is actually moving upwards, or do you worry about liquidity?
No, I mean, again, it's not like the Fed is completely exiting their QE program. They're just making it more difficult for us to sustain these higher valuation levels. So, yeah, I think volatility is going to be up. You get people who want to play in the VIX options is something that you can play in, but as a hedge. But the real thing is that this is more normal. It's healthy. Stay calm, embrace the pullback, but just know that there's a good chance it'll be more than the normal 3 to 5%, or what's been normal this year is 3 to 5%. It could be more.
So, Matt, if you had to make a growth versus value call for the final 3.5 months of the year, what would it be?
Definitely value. I think that we're returning to that situation that we had from August of last year until March of this year. This tapering back of QE will eventually cause rates to move a little bit higher. Right now they're going down because of flight to safety. They'll go a little bit higher. That's going to be tough for technology, tough for growth. That's why I like value for and into next year as well.
Matt, thank you so much. Matt Maley there, Chief Market Strategist at Miller Tabak. Now, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And the president in Afghanistan says he fled the country over the weekend to avoid being hanged. Ashraf Ghani is now in the United Arab Emirates. He says he left on Sunday after security officials warned him that Taliban fighters wanted to execute him. Ghani denies reports that he left with a helicopter full of cash. The International Monetary Fund, meanwhile, says that the new government in Afghanistan is cut off from using fund reserve assets. That comes just days before the nation was set to receive $500 million, and it deprives the Taliban of key resources. The IMF says Afghanistan cannot use the money because the new regime lacks international recognition. In Haiti, the death toll from that earthquake last weekend has risen to almost 2,200. Meanwhile, tensions have been rising over the slow pace of aid reaching victims. They've complained of inadequate food and material needed to temporarily repair damaged homes. And shares of Alibaba fell to a record low in Hong Kong today. That extended a sell-off into the Chinese tech giants after Beijing hit the industry with new regulations. China says it's studying proposals to further ensure the rights of drivers who work for online companies. And I know that Alibaba story is one that you have a close eye on, Matt, and you're seeing it show up in the ADRs in pre-market trading here in the U.S. as well.
Yeah, you know, I just think it's fascinating that we keep seeing these big drops in mega cap tech companies, I should say, in China. And we saw, obviously, in the 13Fs that a lot of famous names had reduced their exposure to China. But I wonder if anybody is brave enough here to take the plunge and go and try and catch a falling knife. I mean, at some point, these companies have to be worth more than the current valuations would suggest. Yeah. Unless, of course, China is really serious about this clampdown and wants to break them up.
Yeah, I mean, look, we're day 3 of the National People's Congress, and what we're hearing on the ground is that this is also about, wealth tax and actually making a fairer society. So it's unclear exactly how far they'll go.
It's about politics
I know Richard
as well,
Windsor
yep.
with a fabulous note from Richard Windsor saying, look, Tencent is most at risk from it despite good behavior. So coming up, we'll have plenty more on foreign affairs as well. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Francine Lacqua here in London, Matt Miller in Berlin, and Kailey Leinz in New York. Matt, we're seeing a pretty big sell-off when it comes to European stocks. The catalyst, I imagine, is a little bit of the Fed minutes, the anxiousness over growth, and the Delta variant.
Yeah, absolutely. And I think, the politics coming out of China, the point you just made, are also driving, to some extent, markets. I thought it was really interesting talking to Matt Maley of Miller Tabak when he said, you know what, this could be more. This is likely to be more than just a 3 to 5% pullback. We're seeing a real turning point now. It's no longer just a little bit of softness in indexes, a little bit of weakness, maybe a summer lull or profit taking. There are 3% plus drops here in Europe. We're seeing Brent crude fall to $66. Everyone's piling into the U.S. dollar or the Japanese yen, getting into those haven trades. So I think it's a really interesting day for markets, one that won't soon be forgotten.
Yeah, and it's really playing out on markets overall, Kailey, all asset classes.
Yeah, it absolutely is. As Matt was saying, it is definitely a deeply red session in Europe. Stocks really lower across the board. And in France, actually, the CAC 40 now is down around 3%. The Stock 600 down about 2%, right around session lows. Here in the U.S., we are just off of session lows. But when it comes to S&P 500 futures, they are still down about 0.9% with 4 hours to go until the opening bell. You are seeing that bid for safety showing up in the Treasury market. We're down 3 basis points on the U.S. 10-year yield to 122. You're also seeing that safety bid, as Matt said, into the U.S. dollar, which is at its strongest since back in November. And that, coupled with demand and growth concerns, is weighing on the commodity complex. Oil is a poster child for that today, down 4% on WTI, 6th down day in a row. We are below $63 a barrel, which is the lowest since back in May. And with those moves in commodities, you are seeing stocks tied to them moving lower in pre-market trading. Devon Energy down 5.5%. Freeport-McMoRan, which of course is a miner, is down 4%. And then on to those China fears Matt was talking about. U.S. ADRs of big Chinese tech companies are falling. Alibaba down 4%. Finally, have to note Robinhood as well. This is separate. This is an earnings story. It saw a huge boom in revenue in the second quarter thanks to crypto and specifically to Dogecoin, but they don't think that's going to last. And as a result, investors punishing those shares down about 12% before the bell, Matt.
All right, now let's get back to foreign affairs. As Francine was saying, an ally of German Chancellor Angela Merkel is condemning President Joe Biden's decision to rapidly withdraw from Afghanistan.
It's absolutely clear that we have to acknowledge that the United States will no longer be the policeman of the world and help us to live here secure in Europe. We have to do more.
Joining us now is Nils Schmid, German Social Democrat, Foreign Affairs spokesman, and also a representative at the Bundestag. Nils, it seemed to me that the Germans started to get the message you can no longer count on the military support of the United States of America under President Trump. Is that message being amplified by President Biden?
Yes, it is, because if you look at Afghanistan, you have to take into account that we used to have 3 leverage points. And the most important of those was military presence. And this was completely dependent on American military presence, because from the very beginning, and now even with the evacuation mission, we are highly and completely dependent on American forces there. And the 2 other leverage points are international recognition of the Taliban and financial aid to Afghanistan. In this respect, of course, Germany and Europe can do a lot on its own, but still, we have to recognize that starting with the Obama administration, America has started a relative withdrawal from world affairs, especially when it comes to the Middle East and to the immediate European neighbors. So we have to take on more responsibility as Europeans. That's true.
Nils, President Biden said that the U.S. was prepared for every contingency and later said that this disaster unraveling in Afghanistan was unavoidable. Do you agree?
In a sense, yes, because it seems that the Afghan forces on their own were not capable or not willing to fight back against the Taliban. But we also have to admit that there was a bad miscalculation on our side regarding the strength, the military strength of the central Afghan government and its forces. And this came as a surprise to all of us. Last Friday, our intelligence service told us that Kabul will not fall soon. And 2 days later, fell.
But Nils, how is this possible? I mean, the Allies and NATO were in Afghanistan for 20 years. So why is the intelligence coming back with things that actually are not true because it took 3 days and took us instead of 3 weeks?
Yeah, that has to be inquired very deeply, not only in Germany, but all over the Western countries. Maybe we just wanted to believe that the Afghan government and its security forces were strong enough. So there was also a sort of self-deception in it.
Nils, we had a conversation with Johan Wadepoel, basically slamming the U.S. Because of what's happening in Afghanistan, saying the U.S. is no longer the world policeman. What does it mean for Europe? What does it mean for Germany going forward?
Well, when it comes to Afghanistan, we cannot do a lot on our own as Europeans. But I think we will see more of a division of labor between the U.S. and Europeans. So
I gotta jump in. I gotta jump in, Nils, because when I saw that you were sending 2 A400s down to Kabul, I thought, well, those must be the only 2 A400s Germany has. The lack of equipment, the lack of personnel that the Bundeswehr has had over the past years. I mean, there's stories of soldiers training with broomsticks because they don't have enough rifles. Is that something that you've got to do something about?
Yeah, for sure. And we have done a lot about it over the last 4 years, increasing the defense budget largely. So the most important part of increases in the federal budget was dedicated to our defense, which is right and which has to continue. But still, labor will be the future of the transatlantic partnership when it comes to security. So we will have to do more for the Mediterranean, for the Middle East, for the post-Soviet space. We cannot do much, and we will not make much of a difference when it comes to the Indo-Pacific in military terms. So sending a German frigate to the South China Sea is fine and deserves our full support. But in military terms, much will depend on the US and on its regional partners in the Indo-Pacific, but much more will depend on Europe when it comes to Northern Africa, the Middle East, and the former Soviet Union.
I need to ask you about refugees because obviously there are now thousands of Afghans who are going to attempt to leave the country. And I know that in the conservative coalition in Germany, there is not a desire to repeat 2015. So what is your stance on taking in refugees now?
Well, I think any comparison with 2015 is ill-guided because we do not have thousands of Afghan refugees in the Balkans right now. The Afghan borders are closed and most of the refugees will come to Iran or Pakistan, and that's where we should help them and support these countries who are ready to take in more of the refugees. But of course, we Germans, we should also take in refugees, especially those who risk political persecution by the Taliban. I mean, female activists, human rights activists, journalists. A lot of NGOs are now under threat by the Taliban, and we should be very generous in taking them in Germany. And we have already seen an agreement among states and the federal government to do so.
Thank you so much, Nils Schmid there, the German Social Democrat Foreign Affairs spokesperson and Bundestag member. Coming up next, we'll also speak with the Gallup Editor-in-Chief Mohamed Younis about the latest opinions on Afghanistan and work from home. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, the mayor of the city of Miami, Francis Suarez. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, President Joe Biden says that U.S. troops will remain in Afghanistan until all Americans are able to leave the country. According to a recent Gallup poll, Americans are evenly divided in their views on whether it was a mistake for the U.S. to send troops there in the first place. Well, joining us now is Mohamed Younis, Gallup Editor-in-Chief. Mohamed, you always make us smarter on the thinking of American citizens, so it's always valuable to have your latest polls. What's the think on Afghanistan? Some of the questions that you've asked, I imagine, are very wide-ranging.
Absolutely. And what's really fascinating, Francine, is to compare perceptions of the war in Afghanistan to so many other conflicts in modern history in the U.S. Afghanistan is unique. It's actually taken quite a long time, much longer than the Iraq War, for example, to get to a place where Americans were evenly split. The last time we asked Americans about that question in specific, the mistake question, was literally 2 weeks before all of this started unfolding on our television screen. So Americans were split. There's been a partisan split on Afghanistan for quite a while. But like most wars that we've asked about, so going back to Korea, with the exception of the Persian Gulf War, every conflict ended on the wrong side of public opinion at the end of the war, but started out much better at the beginning. And I think Afghanistan is headed in that direction.
Mohamed, will you do other polls on Afghanistan on the withdrawal of troops, or is there little interest actually by the common man on the street on answering some of those questions?
That's such a remarkable question because, yes, there is actually little interest to our chagrin who live and breathe these topics. Obviously, now the American public is locked into the people on the ground trying to get out of Kabul. We will certainly continue to ask about that situation and also reflect on the withdrawal. But it's clear that things did not unfold the way it was planned. And the political fallout for the Biden team remains to be seen. I think it's too early to determine what it'll be.
Yeah, I'm concerned about getting American troops out, Mohamed. They're, a lot of them are just kids, obviously, but equally worried about people like the interpreter. Bloomberg did a story yesterday on an interpreter who, put his trust and faith in the Americans, hoping for a better future for his family. And now the Taliban is knocking on his door. He can't get a visa. He can't get through the security lines to the airport. I mean, are Americans concerned about the Afghan citizens who risked everything for us?
Yeah, they are. I think it's actually really interesting to note that despite refugees being such a politically nuclear topic, particularly last year and the year before, we haven't seen this widespread outcry of don't let these people come. It's been actually quite the opposite. We've seen Republican voices take the opportunity to attack the Biden team by saying, how could you leave these people behind? So now the social pressure, the public pressure is in a very different direction than it is usually with the refugee issue.
How has this crisis in particular altered the perception of America's standing and power in the world?
I was so fascinated by your previous interview and this notion of America being the policeman of the world. I was dying to share that Americans actually don't want America to be the policeman of the world. And I think that's a surprising notion to many people who watch U.S. foreign policy. There's a huge disconnect between what Americans wake up and think about every day, hint, hint, what they think about when they go to vote in a midterm election, and what's happening on the other side of the world, particularly when it doesn't involve American lives at risk and doesn't necessarily impact the local realities here, like 9/11, for example. So unless we unfortunately see that kind of a development, it will be an outlier if this event tends to have a huge impact, for example, on the upcoming midterm election. But again, it's still too early to determine.
Of course, aside from geopolitics, another issue we're dealing with domestically and abroad is the continued spread of the coronavirus and the Delta variant. How has that altered Americans' perceptions of vaccines, for example?
American perceptions of vaccines have stayed really stable. What's changed is what Americans want to see their employers doing about vaccines. Right now, 62% of Americans say their employer is encouraging them to have the vaccine before they come back to work. 52% of Americans favor employers requiring the vaccine to be taken before work. But remote work is really where everything has proverbially hit the fan because many people were planning to come back. Many organizations and companies were bringing people back. And then we got hit by this Delta variant. So I'd love to take you through kind of the state of where remote work is now and what the desires are for the future. Right now, half of Americans tell us that they are routinely working offsite. Within that half, 3 in 10 are exclusively offsite, and 2 in 10 are doing a hybrid, going back and forth. The other half are fully on site. Moving forward, 40% of Americans expect to have long-term remote work options from their employer, but their desire is closer to 7 in 10 or even 8 in 10 that want to have some kind of a hybrid remote work offering. What this tells us is when employers take the approach of scaring people back into the office, we know that they're going to lose talent because the expectations now are not going back to it.
You know, there's controversial talk about actually cutting people's pay if they're working from home more. I mean, are people in your polls actually ready to take a pay cut if they can work from home?
That's a great question. It's certainly a major factor in whether or not people are going to consider moving. The other piece to this is, can they find another opportunity, right? So if my employer is going to cut my pay in this labor market, I might have great opportunities at another organization where they're not going to cut my pay. So I think it's really hard to have a definitive answer on that question, but certainly pay is a really critical part of the remote work consideration generally. It's not just that people are focused on living far away and not commuting. They certainly don't want to take a massive pay cut, especially if their hours are not going to change.
Mohamed, what's driving the vaccine hesitant in America? I mean, there's an extreme contingency that believes, Bill Gates is trying to inject them with 5G nanobots, but there's obviously a much more down-to-earth group that is just concerned about the efficacy or the effects then of the vaccine. Is that changing?
No, it's not actually. Persistence of the people who are refusing to take it, we haven't seen change. The number one issue is absolutely that they cite is the fact that there isn't a lot of information, or they want more information, or they're concerned about the quickness of the approval process. But we're not seeing a lot of movement, frankly, in attitudes about the willingness to take the vaccine itself.
Mohamed, thank you so much for joining us. Mohamed Younis there, the Gallup Editor-in-Chief. Now, coming up a little bit later, we'll be hearing from Andy Slavitt, the President Biden's former top pandemic advisor, That's on Balance of Powers at 12 p.m. New York time, 5 p.m. in London. That'll be a conversation on boosters and, of course, vaccines. This is Bloomberg.
I think the issue today is whether the policy responses that policymakers are going to have to make, and it's a very difficult and fine balancing act, that they make a misstep on that. But if they make a misstep, I think they are likely to tighten too late rather than too early, just because we're still in an unknown territory with the pandemic. With what happened, we've got Delta accelerating, obviously, but what else happens? Could they see it be another mutation?
Dame Ann Richards there, the Chief Executive of Fidelity International, speaking earlier on Bloomberg. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. And Tom, it was interesting, actually, conversation with Ann Richards, where she says that her biggest concern when it comes to policymakers is that they actually delay it too much and we have runaway inflation.
Well, that's the timeline, the x-axis. That's going to be a huge theme at Jackson Hole, and I believe it's 9 days. Francine, the morning within the debris of a drawdown, as John Farrow would call it, you have to look for the deepest market. That's always the Dow dollar, I'm going to go to the acclaimed Bloomberg Dollar Index. This is very good math, folks. This is really everybody in, including renminbi, out to 6.49 yuan, a weaker Chinese renminbi. And we're sort of breaking out of the present range to get above the proverbial pink line. And a climb in moving average study would be a huge deal. We're not there yet.
Tom, I thought of you when I was reading the minutes yesterday. They say various participants saw a reduction in coming months. Several indicated it would be appropriate next year. But most judged it could be appropriate this year. It does seem to have at least marked a turning point for markets, right? Because we see big movements in FX, 116 and 136 on the euro and pound respectively. Big movements in oil down to 66 on Brent. Big movements in the dollar, as you show, and the yen. I mean, people are going to havens.
People are going to havens, and we're beginning to see an impact. What you do is you bring up each of the charts, Matt, on the terminal, and if they're within the range, well, they don't get my attention. Once they break out of a range, up or down, whichever the series is, that gets my attention. There's very few of these series yet breaking out of their range, including the 10-year yield.
Interesting. Tom, thank you so much. Tom Keene, co-anchor of Bloomberg Surveillance, shortly with the program. Now, here's a look at what else we're watching. Kailey, what's on your mind?
I'm watching commodities, Francine, and Matt was just alluding to this. Plunging iron ore futures in the Asian session. You have copper, oil, pretty much any industrial metal that you can think of is also down today. Both crude and copper down more than 3%. And to me, is this just a Fed story? Is this a stronger dollar story? Or is this a concern about China and demand and the crackdown in steel production, Matt? There's a lot of factors now that seem to be working against the commodity complex.
I never thought of the etymology of John Farrow's name. I wonder if he watches iron ore more closely than others because of that connection. I'm watching initial jobless claims. We're looking for 364,000, but the Delta variant has really thrown a wrench into a lot of different works. So we'll see if it hits the U.S. labor market as well. Obviously, it's not as big as the granddaddy of all economic statistics, non-farm payrolls, but it's still one that I think the market is going to pay relatively close attention to coming out at it's coming out at 2:30 my time. So what's that? That's 8:30 Wall Street. Yep.
This is a great way of calculating maths, actually. Just go around the world with like time zones. That's what you should do with little kids in the classroom. Now, I'm looking at the prolonged, of course, chip shortage, and it's increasingly biting into the automobile industry with Toyota's output, for example.
And worsening.
And worsening, the continued supply problem on some crucial parts could undermine some of the car-related stocks, but also indices globally. So I'm looking at Toyota actually announcing that it was going to cut global output 40% for the month of September. More Bloomberg Surveillance is coming up ahead. We'll hear from Ian Shepardson, Pantheon Macroeconomics Chief Economist. This is Bloomberg.